How's it going out there? Welcome to Stock Talk with Mike. Today, I'm going to break down the three big publicly traded players that are disrupting the real estate industry. And I think everyone should have exposure to this space right now. And those three companies I'm going to talk about are Redfin, Zillow, and Opendoor. And I'm going to let you know what I think my favorite pick amongst the three is and what their competitive advantage is based on their current market position. So anyways, if you like this kind of content, please consider subscribing to the channel and liking this video. All right, so just really quick, guys, the real estate industry is obviously massive. It's $1.6 trillion spent on real estate every year, with over 5 million homes sold by over 2 million real estate agents. And obviously the home buying process is ridiculously stressful, really long drawn out process, and crazy expensive. So just right off the hop, typical or traditional real estate fees, commissions are around 6% of the transaction cost, and total cost can be up over 12% of the transaction, which is just crazy expensive traditionally to buy and sell a home. So I've been really interested in finding companies that are disrupting that industry and finding a simpler, easier way and more efficient and cost-effective using technology way to buy a home. All right, so I did a bit of a deep dive into what the difference is as far as the products and services that these three companies offer. They all had their own origin and slowly, I think, moved into each other's niche sort of markets. And in green, I've highlighted who I think the leader in the category is. So the first one being iBuyers. So that's basically when they give you an instant offer for your property, and if you accept, you get paid all cash instantly, no waiting for a closing date or contingent on inspection or financing or anything like that. So removing a lot of the stress and uncertainty around the home selling experience, and it may or may not end up being cheaper than listing with a traditional agent. So all three companies offer an iBuyer program now, but Opendoor really is the true leader in that category. They're the most pure play iBuyer, and also have the best gross margins on that segment as well. Whereas Redfin is really in their infancy with the Redfin Now, just started that program, and Zillow somewhere in the middle. They both Redfin and Opendoor offer a service where you can pay a fee for them to act as a contractor and have your house basically fixed up before you sell it as well. And Redfin also has this brokerage program where they'll act as your real estate agent if you sign up to buy and sell with them for 1% fee. So that's pretty disruptive to the traditional market, which is usually 3% on either side for 6%. So that's pretty massive. So that's really of interest to me. And both Redfin and Zillow offer mortgages as well. And Redfin has moved into title services. And then Zillow has something also of interest called their premium agent, which basically is an advertising platform that sort of connects agents with buyers and sellers, which is really high margin and revenue generating for them. So you can see that I have more green here for Redfin, and I've actually selected Redfin as my leader, as I think they're really moving towards that vertically integrated product where they're sort of a one-stop shop for buying and selling a home and offer any kind of product that you could desire. So I really like that about Redfin, and I really like their 1% listing component, in addition to their fastly going Redfin Now, which isn't profitable yet. But that component, as it grows and they fine tune it, I assume they'll have similar margins as Opendoor. You'll see in the next slide that actually Redfin also had the best earnings, at least last quarter. They were profitable. So I do like that component as well. But I do think there could be multiple winners in the space, and I actually do have shares also of Opendoor, as I really believe in this disruptive industry. But one thing I'm watching closely is the effect that a down housing market may have on these iBuyers. What happens when they buy a property and housing prices are dropping and they can't find buyers or have to sell the property for a loss? That I could see that being a bit of a headwind in a down market for especially a pure play iBuyer like Opendoor. So Redfin has about an $8 billion market cap, Zillow $33 billion, Opendoor $14. And you can see all three companies have just been red hot this year or this past year. Redfin's up 222% over the last 52 weeks. Zillow 204%. Opendoor 148%. So, and they just went public via SPAC, special purpose acquisition company. What was it? It's in the fall, so only a few months ago. And one thing you have to watch is just looking at the top line for these companies. So looking at, say, like price to sales, it can be incredibly misleading. So you can see Redfin trades at a price to sales of 9.09, Zillow 9.69, so a little more expensive Redfin, and then Opendoor 4.02. It's cheap comparatively, it looks like. But what you have to keep in mind is that iBuyer, those is really low margin business, right? Like if they're selling a home that they bought, they're likely to get 5% profit on that home. So it's not the same kind of margins as a company like Redfin that has these other products and services that operate with a much higher margin. They also have an iBuyer segment, so I imagine those margins will be compressed once they grow that iBuyer program, but it's a trade-off with more revenue too. So but something to keep in mind, you can't really compare them across the board with that simple of a metric. And all three companies had declining revenues this year and in Q3. And that was because of COVID. They actually temporarily halted their iBuying component of their business, which is such a large component of their revenue. So Redfin was just slightly negative, where Zillow was down about 12% and Opendoor about 12%. I think Redfin was a little more resilient because even though the iBuyer program was basically switched off, they have more diversified percentage of their revenue into other baskets with their typical commission brokerage and whatnot, and mortgages services and whatnot. So I think that kind of can put a tail to the future, that when the housing market maybe isn't so hot, that their diversified business model might work in their favor during those sort of housing market downturns. And they actually, Redfin had a profitable quarter of earnings per share of 36 cents. So did Zillow. So both these companies turned the corner of profitability. Zillow was 17 cents. And Opendoor, we don't have a Q3 because they just came public, but it's expected to be operate at a loss. I'll show you what I mean here. Looking at Opendoor's last filing we do have, for the first 6 months of 2020, you can see their revenue, which is mostly from the iBuying, is just shy of $2 billion. But then the cost of revenue is $1,850,000. So they have about a margin there of 7%, which on a home iBuying program is actually probably pretty good. But you compare that to, say, even Zillow here. Look at their IMT. So that's Internet, Media, and Technology. So that's their Premier Agent program. It's $450 million of revenue. Look at the costs. Look at the expenses here for that revenue, same revenue, just $28 million. So that's a margin of 92%. So just looking at sales would be pretty misleading when that revenue is generating a lot more net income than an iBuy program currently would do. So it's just the pure volume of revenue is misleading when we're talking about home buying. Where you can see here, look at their home segment in green. They had $187 million in home sales in the quarter, and the cost of that was 170 of that revenue was 179 million. So just a 3.9% margin on that. So huge discrepancy between the type of revenue sources for these companies. So you almost have to look at those segments separately to get a better sense of how they're doing. And even further, we look at Redfin here as well, their Q3. So services is their mortgage products, it's their commission brokerage service, and that's revenue was 217 million on the quarter, and the cost of that service revenue was 122 million. So that's a 44% margin on those services versus the product line here is their iBuyer program. And you can see actually it was way down on the quarter. You compare it to 2019. So in green here, last quarter, 2018, it was 80 million, just 19 million this year. And that was due to COVID and them halting their iBuyer program for a period of time. But look at the margins. So in revenue, 19 million or 19,636,000, and then the cost of that product actually 21,261,000. So they're actually losing money on their iBuyer program. So definitely something to keep an eye on. Even look the 9 months to date. Revenue of their iBuyer program was 171 million. Cost of that product for the iBuyer was 174 million. So they're actually losing on monies that they're instant buying and selling. But I'm confident that they can get that right as they grow that program. But I really like that these other revenue streams are such high margin. So you have to keep that in mind when you're evaluating these companies. So here's my price predictions for Redfin. I used their Q3 and then their guidance they gave for the remainder of the year to generate some numbers for 2020. And now I'm looking 5 years out where I think the stock price could be. So in 2025. And I actually chose a different growth rate for their services side. So remember, their services is things like their mortgage, their title insurance, their commission on standard realtor brokerage. And then the product side is their iBuyer program. I chose different rates because we've seen that they kind of grow at a different rate and they also have different margins. So I've chose some different numbers for those different categories. So for the services side, I chose a 20% growth rate year over year for the next 5 years. Last quarter, it actually grew 37%. So I think that's fairly conservative. But year to date, they're only like 16% or so. So I went with 20. For the iBuyer program or products, I went with 50% growth per year over the next 5 years, as I think they'll aggressively ramp up that program because it's still quite a small component for them. And then also Q3 was negative as far as that growth, but Q2 was up 82%. So I think 50 is reasonable based on where they want to go. And then I also looked at what I thought as far as margins on those different products. So for the iBuyer program or expense product, I chose a 5% margin, which I think they can get to. Remember, Opendoor's was 7%. And then for their services side, a 60% margin. So actually improving the margins a little bit from currently where they're at around 44%. So choosing with a PE of around 60, that would get us to a price per share of around $127.41 in 2025. So that's only an average return of 10.4% over the next 5 years. But keep in mind, if it has a higher valuation than 60 current PE based on those growth rates, which is totally reasonable, it has a higher, definitely higher valuation now, it's very possible the stock price could trade much higher. But I like to be conservative on my estimates to look at like what's reasonable for where this stock could go. So for me, I'm a shareholder currently. I did trim a little at 80, but I am a long-term holder, so I still have a pretty good sized core position. But I'd be looking to load up more if this stock got towards like around into the lower 60s again, as I think it has more potential good outsized returns over the next 5 years at that price range. So it's not a knock on the company. I really like it. And if I wasn't in it, I'd be looking to get in it. It's just had such a big run up already in 2020 that I think it needs to absorb some of those gains, and it'll probably sort of, I think, stagnate here for a while and maybe retrace a little bit. And that'll be your time to load up. So anyways, that's all I got for you today. Thank you very much for watching. Remember, always do your own research and due diligence before making any investment decisions. Happy investing.